Welcome back to the channel, traders. Today we're tackling one of the most talked about but often misunderstood topics in trading, risk-reward ratios. Now let me ask you this. Have you ever been told, stick to a 3:1 ratio and you'll make money? Or maybe you've tried adjusting your reward ratio only to end up with inconsistent results. Well, today's video will help you uncover the truth about risk-reward ratios, why simply increasing your ratio won't magically make you profitable, and how to objectively assess your risk and reward for smarter trading decisions. So stick around, hit that like button, and subscribe to stay updated with the best trading strategies and insights. Alright, let's start by addressing a common misconception. Many traders believe that sticking to a high risk-reward ratio, say 3.1 or 4:1, is the key to trading success. But here's the harsh reality. Risk-reward ratios alone won't make you profitable. Let's look at why. A 3.1 ratio sounds great, right? You're risking $1 to make $3. But profitability doesn't just depend on how much you aim to win versus how much you risk. It's a combination of three factors: your risk-reward ratio, your win rate, and your ability to execute consistently. For instance, you could have a 3:1 ratio, but if your win rate is only 20%, you'll end up losing money. On the flip side, if your win rate is 80%, even a 1:1 ratio can be profitable. Here's a quick analogy. Imagine you're a basketball player. You might aim for 3-point shots all the time, but if you only make 1 out of every 10 attempts, your team isn't going to win. Sometimes it's better to go for the safer 2-pointers if you know you can consistently make them. Now here's something most traders overlook. Context is everything. Risk-reward ratios can't be applied blindly. You need to adapt to the market conditions you're trading in. For example, in a volatile market, your stop loss might need to be wider to account for price fluctuations. Using a tight stop just to achieve a higher reward ratio will often result in getting stopped out prematurely. Conversely, in a slower market, aiming for overly ambitious profit targets may leave you stuck in trades that never reach their potential. This is why a fixed, one-size-fits-all ratio can do more harm than good. Markets are dynamic, and your approach needs to reflect that dynamism. The key is to use a framework for assessing risk and reward objectively, and that's what we'll dive into next. How to assess risk-reward objectively. First, you need to define your risk clearly. How much are you willing to lose on a single trade? The general rule of thumb is 1 to 2% of your trading capital per trade. This ensures that a string of losing trades won't wipe out your account. But here's the critical part. Your stop loss should be based on market logic, not a random percentage. Use technical levels like support, resistance, or volatility indicators like the average true range, ATR. Your stop loss should mark the point where your trade idea is invalidated, not where you feel comfortable losing money. Next, focus on setting a realistic reward. Don't just pick a number because it gives you a 3.1 ratio. Look at market conditions to determine where price is likely to go. Key resistance levels, Fibonacci extensions, or measured moves are great tools for this. For example, if the market is trending strongly, you might aim for a larger reward, but if it's consolidating, your targets should be more conservative. The key is aligning your targets with what the market is offering, not what you wish it would do. Finally, you need to know your win rate. This is the percentage of trades you win out of the total trades you take. Historical data and backtesting are essential for this step. If your win rate is 50% and your reward ratio is 2.1, you're in a good spot. But if your win rate drops to 30%, you'll need a much higher reward ratio just to break even. To bring this all together, use the profit factor formula. Win rate x reward, loss rate x risk. For example, if you have a 50% win rate and a 2.1 ratio, your profit factor would be 0.5x2, 0.5x1, 0.2. A profit factor above 1 means your system is profitable. But remember, this only works if your stop loss and target are placed logically based on market context. Let's apply this to a hypothetical trade. Say you're risking $100 with a stop-loss set just below a key support level. Your target is $200, which aligns with the next major resistance level. With a 50% win rate, this setup is statistically sound. But if you randomly place a stop-loss $50 below your entry just to achieve a higher reward ratio, you'll likely get stopped out unnecessarily. Before we wrap up, let's talk about common mistakes traders make with risk-reward. First, forcing fixed ratios. Aiming for 3.1 on every trade ignores market realities. Let the market guide your levels. Second, ignoring your win rate. Even a high reward ratio won't save you if your win rate is too low. And third, over-leveraging. Risking more than 2% of your capital per trade is a recipe for disaster. Final tips for success. The most successful traders know that trading isn't about rigid rules, it's about flexibility and discipline. Use risk-reward ratios as a tool, not a crutch. Combine them with sound analysis, disciplined execution, and an understanding of market context. So, there you have it. The truth about risk-reward ratios and how to assess them objectively. Remember, it's not about aiming for the highest ratio. It's about balancing risk, reward, and win rate in a way that works for you. If you found this video helpful, give it a thumbs up and subscribe for more actionable trading insights. And let me know in the comments, how do you approach risk-reward in your trading? I'd love to hear your thoughts. Thanks for watching, and until next time, trade smart and stay disciplined. See you in the next video.